Well, what if I told you that almost everything you've been taught about trend lines is just scratching the surface? In this video, I'm going to reveal everything you need to know about how to trade using trend lines, but not just in the way beginner traders do. I'm talking about the way bank traders and institutional professionals use them to dominate the markets. So get ready, grab your notebook, and let's jump straight into the lesson. All right, first things first, what exactly are trend lines? Trend lines are essentially key levels that naturally form within a trending market. These lines help us visually define the market's direction, whether it's moving upward or downward. But more importantly, they act as strategic points where price tends to react, making them incredibly valuable tools in technical analysis. Now, why do we actually draw trend lines? The reason is simple. When price moves and starts approaching these key trendline levels, it often creates high probability trading opportunities. In many cases, these levels can offer setups with very high win rates, especially when you know what to look for. Let me break it down even further. When price approaches a trend line, there are two main types of patterns that can form, and both are essential to any effective trend line strategy. The first is called a continuation pattern. This pattern forms when the price touches a trend line and then bounces back in the direction of the existing trend. For example, if the market is in an uptrend, the price hits the trend line, finds support, and then continues moving upward. This is a strong signal that the trend is holding, and it can lead to a solid entry point. The second is the breakout pattern. This one happens when the price breaks through the trend line instead of bouncing off it. When that occurs, it signals that the existing trend might be coming to an end, and we could be seeing the beginning of a trend reversal in the opposite direction. But here's a critical point you must not overlook. Just because the price touches a trend line doesn't automatically mean a trend reversal is about to happen. That's a common mistake many beginners make. In reality, you need to support your analysis with additional price action confirmation techniques. And don't worry, I'll cover exactly how to do that later in this video. So now that you understand what trend lines are and why they matter, it's time to dive into the actual technique. Let me show you a simple, effective way to draw trend lines correctly, so you can start applying them to your own chart, just like professional traders do. One of the most common questions I get from beginner traders when it comes to drawing trend lines is this: should I place the trend line at the wick's end? Should I align it with the candle's close? Or should I go with the candle's body? It's a great question, and an important one, but here's the answer. You want to draw your trend line in a way that gives you the highest number of valid touches. That's it. That's the key. The more price points your trend line connects with, the more reliable it becomes. Let's break that down with a real example. Take a look at this chart. Here we're clearly in an uptrend. The market is consistently forming higher highs and higher lows, a textbook sign that the price is moving upward with momentum. And because we're in an uptrend, we want to draw our trend line beneath the price action, not above it. The trend line should sit just below the rising price structure, acting as a dynamic level of support. Once the general position is set, your next step is to adjust that line, refine it so that it touches as many swing lows as possible. You want to capture those points where price reacted even slightly. That's what builds confidence in the trend line. Now, you'll probably notice something interesting. Some of the candles may overlap the trend line, and some may not touch it at all. And that's completely fine. In fact, that's normal, because a trend line isn't supposed to be an exact pixel-perfect level. It's not a laser line. Instead, it should be treated as a general area, much like how we treat support and resistance zones. Think of it this way. You're not looking for perfection. You're looking for confluence. You're identifying a zone where price tends to react, not a precise number that price has to hit. And that's how you draw a trend line that actually works in real-world trading, not just something that looks good in theory. All right, let's take a look at another example, this time in a downtrend. On this chart, you'll notice that price action is clearly forming lower highs and lower lows, which is a classic sign that the market is trending downward. And since we're dealing with a downtrend here, your approach to drawing the trend line will be slightly different from what we did in the uptrend example. So instead of placing the trend line below the candles like we do in an uptrend, in a downtrend, you want to position your trend line above the price action. This means you're aligning the line along the swing highs, essentially tracking where price keeps getting rejected as it moves lower. Now here's the important part. Once you've placed your trend line above the downtrend, you need to take a moment to adjust it carefully. The goal here is to make sure it touches as many key points, meaning the swing highs, as possible. The more price respects that line by touching it or getting close to it, the more reliable that trend line becomes in identifying potential trade setups. And honestly, it really is back straightforward. So now at this point, you should have a solid understanding of how to draw trend lines accurately and effectively, both in uptrends and downtrends. But drawing the lines is just the beginning. In the next part of this video, we're going to go much deeper. I'll show you exactly how to use these trend lines, not just to read the market, but to actually spot high probability trade setups. These are the kinds of setups professional trade traders look for. Setups with strong risk-reward potential that can significantly improve your overall accuracy and consistency. So, if you're ready to move beyond the basics and start trading with the same mindset as institutional level traders, let's dive right in. Let's begin by talking about the continuation pattern, one of the most important patterns you'll encounter when trading with trend lines. This pattern forms when the price pulls back to the trend line and then quickly bounces back in the direction of the original trend. It's basically the market saying, hey, I'm just taking a quick breather before I continue moving in the same direction. And when you spot it correctly, it can offer you some incredibly high probability trading opportunities. But here's the thing you absolutely need to remember. Just because price touches your trend line does not mean you should jump into a trade right away. That's a common mistake among beginners. A single touch isn't enough confirmation. You need to combine it with other price action techniques to validate that what you're seeing is truly a continuation, not a reversal in disguise. One highly effective technique you can use to confirm a continuation pattern is by drawing a mini trend line at the point where the pullback occurs. This mini trend line tracks the small retracement against the main trend. Once you've drawn that mini trend line, your job is to wait patiently for price to break above it. That's your confirmation. When price breaks through that mini downtrend line, it signals that the pullback is likely over and the main trend is about to resume. And that's your entry trigger. After the breakout is confirmed, you enter a buy position, either right at the close of the breakout candle or the open of the next candle, depending on your entry style. Now, before we move any further, let me show you something powerful. This is a key insight that can take your trendline strategy to the next level and help you identify high probability trade signals with confidence. Take a close look at what happens after the price breaks through the mini trend line. Focus on the structure of the market. What do we see here? We have a sequence of swing lows forming. First we have low 1, then low 2, and now here we see low 3. Now here's what makes it significant. If you observe carefully, these swing lows aren't random. This is a classic textbook definition of a healthy uptrend. It tells us that buyers are stepping in earlier and with more strength each time price dips. So when the price breaks through that mini downtrend line at the same time we're seeing this strong higher-low structure, that's a powerful confirmation. That's your green light. This is now a valid buy signal, one that aligns perfectly with the overall uptrend, and it's backed by price action, structure, and trendline logic. At this point, your best move as a trader is to enter a buy position, either at the close of the breakout candle or right at the open of the next candle, whichever matches your strategy. That's how professional traders stack the odds in their favor. Let's break down another example right here on this chart. What we're seeing is a clear downtrend, so the very first step is to draw your trend line along the top. Right here, following the descending highs. Once that's in place, we shift our focus to the current price action, and what stands out is the potential formation of another continuation pattern. Now this is crucial. Your next move is to confirm that potential continuation. How do you do that? You draw a mini bullish trend line starting from the pullback point within that larger downtrend. Then, once the price decisively breaks below that mini trend line, that's your trigger. It's time to enter a sell position. Just like the previous buy entry case we looked at earlier, there's a powerful trading insight here, something many traders overlook. And if you want to consistently spot high probability trading signals using trend lines, you need to understand this part. Take a close look. After the breakout from that mini trend line is confirmed, zoom in on the swing highs that occurred during this bearish trend. You'll notice a very clear structure. Swing high 1, swing high 2, and right here, swing high 3. If you observe them closely, these 3 points form a distinct sequence. A high, followed by a lower high, and then another lower high. This is a textbook pattern that confirms the presence of a valid downtrend. And that's what makes the sell signal triggered by the breakout of that mini uptrend line not just valid, but highly reliable. Based on this exact signal, the right action for a trader is to immediately execute a sell entry, either at the close of the breakout candle or at the open of the next candle. Because this setup is a valid high probability sell signal within an ongoing bearish trend, what happens next? Boom! The price drops sharply and fast, delivering a solid profit potential in a short amount of time. So this is one of those golden rules, a must-know principle that most beginner traders simply aren't aware of. Now, let's talk about another incredibly useful indicator that can help you confirm continuation patterns with greater confidence, the CCI or Commodity Channel Index. This tool is especially powerful when used alongside trendline analysis. Let me walk you through exactly how this strategy works. On this chart, we're currently observing a bullish trend. So just like before, we begin by placing our half trend line below the price, aligning it with the rising swing lows. Now here's where it gets interesting. As price approaches and touches the trend line again, it begins to show signs of a possible continuation pattern. But to confirm this potential, we turn to the CCI indicator. At this moment, notice that the CCI line is currently sitting below minus of 100. That's a key level. So what we're waiting for is a strong upward move in the CCI, pushing it back up and crossing above the plus 100 level. Once that move is confirmed, that's our green light to enter a buy position. Of course, your stop loss should be placed just below the nearest swing low for risk management. If you're interested in learning more about the CCI indicator, you'll be glad to know that there's a lot you can explore. It's a well-known and widely respected tool among technical traders. But in this tutorial, I'm going to keep it focused and practical. We'll concentrate on the most important aspects. Let's begin with the basics. How to read the CCI indicator to find optimal entry points. If you look closely, the CCI is built around 3 major levels, minus 100, 0, and plus 100. These are the critical thresholds you need to understand if you want to find entry signals that offer high reward potential relative to the risk you're taking on each trade. Now here are the rules for interpreting those levels. 1. In a bullish trend, if the market is already in a confirmed bullish trend, you'll want to wait for the market to enter a deep exhaustion phase. You'll know it's happening when the CCI line drops down below in this 100 level. That's your first clue. Then, if the CCI turns around and starts rising again, breaking up through the 0 level, or even better, blasting through the plus 100 level, that's your signal. It's a valid buy entry. However, if during that pullback the CCI never ever actually drops below minus 100, we simply ignore that phase. Why? Because trades taken in that kind of condition usually don't produce meaningful results. For a bearish trend, now let's flip it. If the market is trending down and already in a clear bearish phase, you wait for the market to enter an exhaustion phase, but this time on the upside, you'll see the CCI line climbing above the plus 100 level. Then once it reverses and starts dropping back down, cutting below the 0 level, or ideally crashing down path below in this 100 level, that's your signal. That's a valid sell entry. On the other hand, if the CCI doesn't quite reach above plus 100 during that exhaustion, just ignore it. Those setups usually don't yield strong results either. By using the CCI in this way, traders no longer need to memorize hundreds of complex price action patterns. You don't need to guess. But of course, if there happens to be a price action pattern that lines up with this CCI signal, that's even better. Now, let's shift gears and talk about the breakout pattern. This pattern forms when the price breaks out of an existing trend line, which often signals that the trend might be about to change direction. But here's something you really need to understand. Just because price breaks a trend line doesn't automatically mean the trend is reversing. You cannot simply jump into a trade the moment you see a breakout. That's a common mistake, and it can lead to costly decisions. Let's break it down with a real chart example. In this case, we see price action clearly breaking below a rising trend line. At first glance, this might tempt you to take a quick sell entry on the next candle. But pause right there. That's not how we trade smart. As I mentioned earlier, we need to look back at the market structure first before making any decision. When we analyze the price history on this chart, we can clearly identify a series of swing lows, and on the flip side, we also see a series of swing highs. This tells us one very important thing: the market is still in a bullish trend. And in a bullish trend, we are not looking for sell signals. What we should be watching for is the formation of a new higher low, because that's where high probability buy signals often emerge. Unfortunately, in this specific case, that new higher low did not form. Instead, the price broke down through the bullish trend line. That's a red flag. It tells us this breakout is not a valid sell signal. Entering a sell position while the market is still in a clearly defined bullish trend is a critical mistake that should be avoided. So what's the right move here? You need to wait for additional confirmation before taking action. One of the smartest ways to do that is by watching for signs that bullish momentum is fading before the market breaks below the bullish trend line. This helps you filter out false breakouts and gives you a much more reliable signal to trade on. Let me walk you through a perfect example to help you understand this setup more clearly. Take a look at this chart. Right here, we can clearly see that the price is moving in an uptrend. So the first thing we do is draw a trend line along the rising price action to mark the structure of this bullish trend. Now, as the trend continues, we notice that price has been consistently making higher highs, which is exactly what we expect in a strong bullish move. But then, suddenly, something changes. If we look closely at the most recent price action, we see that the latest high is actually lower than the previous high. This shift is critical. It means buyers were no longer able to push the price to a new high, and that's a big warning sign. It's one of the clearest early signals that bullish momentum is starting to fade. But that's not all. Right after that lower high forms, price breaks down through the trend line, which further confirms a potential trend reversal. That's a major red flag, and it opens up a high probability opportunity to switch gears and look for a sell position. Now, before you jump into the trade, here's something important. You always need to manage your risk properly. So in this case, once you've decided to enter a sell trade, place your stop loss just above the nearest swing high. That way, if the market suddenly snaps back and the trend line break turns out to be a fake out, your losses are limited and controlled. Let's break this down with another real chart example. Take a look at this setup. Right here, we're clearly looking at a downtrend. The price has been moving lower, forming lower lows, so we draw our trend line across the top, connecting the swing highs to mark the descending trend structure. Now, pay close attention to what happens next. Initially, the market continues to make lower lows, confirming that sellers are still in control. But suddenly, that pattern starts to shift. Instead of forming another lower low, price actually makes a higher low. This subtle change is incredibly important. It's one of the first signs that the bearish momentum is starting to weaken. In other words, the sellers are losing their grip, and the buyers are beginning to step in with more strength. And right after that, something even more significant happens. Price breaks above the trend line. This breakout is a major signal, giving us additional confirmation that the trend may be about to reverse. At this point, we've got strong reason to start looking for a buy opportunity. Of course, we never trade without managing risk, so always make sure to place your stop loss just below the nearest swing low. That way, you protect your capital in case the breakout fails and the trend resumes downward. And there you have it. From a market that looked firmly bearish, we now have a complete trend reversal into a bullish move. That's how you spot the opportunity early and get in at the right time. Another powerful price action signal you can use to confirm a trendline breakout is by identifying a double rejection pattern before the breakout actually happens. This step is absolutely crucial if you want to anticipate a real trend reversal, not a fake out. Let me show you exactly what I mean with this example right here on the chart. We can clearly see that the market is in an uptrend, with price consistently making higher highs, signaling strong bullish momentum. But here's where it gets interesting. As we observe the most recent price action, we notice that the price suddenly fails to make a new higher high. Instead, it forms a double top pattern, a classic structure that signals strong rejection at a key resistance area. This is a major warning sign that momentum is weakening. What happens next? Price breaks below the trend line, and that breakout is our confirmation that the trend is shifting. At this point, we're no longer guessing. We're acting based on clear market signals. This is your opportunity to go short, to enter a sell position with confidence. Now, here's something critically important. Do not overlook this part. This strategy only works if the bullish trend can be clearly identified by a well-defined upward trend line. If you can't draw that trend line clearly, then stop right there. This setup is not valid, and you should not use this strategy. Why is that? Because the clarity of the trend line is what makes this setup so reliable. If the trend line is perfectly clear on the chart, that means it's also visible to every professional trader, bank trader, and institutional player watching the market. That's right, everyone sees the exact same thing. They all recognize the same market structure, the same direction of the trend, and the same key boundaries. So when a double top pattern forms on a clearly drawn bullish trend line, all major market participants interpret it the same way. The market is about to shift from bullish to bearish. Likewise, if a double bottom forms during a clear downtrend, they see it as a signal that the market is likely shifting from bearish to bullish. Once you enter a sell trade after the breakout, make sure you place your stop loss just above the nearest swing high. This protects your trade by controlling risk, which is an essential part of any professional trading plan. And here's the best part, because all the major players, the pros, the banks, and the institutions, share the same market bias at that point, boom, price often drops aggressively, moving fast and far in your favor. That's how this setup can deliver massive profits if executed correctly. Let's walk through another real example so you can clearly see how this strategy plays out in a downtrend. In this case, we're dealing with a bearish market where the overall trend is moving lower. How do we know that? Because the price is consistently forming lower lows, a classic sign of a strong downtrend. To visualize this clearly, we draw a downward trend line across the highs to highlight the structure of the bearish momentum. Now here's what makes this setup so powerful. We spot a familiar pattern forming, a double rejection near the bottom, signaling that the market is reacting strongly to a certain support zone. This indicates that buyers are stepping in and pushing back from that T level, creating a potential reversal zone. What happens next is key. The price breaks above the downward trend line. This breakout is our confirmation, a clear signal that the downtrend is likely over and the market is starting to reverse direction. When that happens, it opens up a strong opportunity to go long, to enter a buy trade with confidence, knowing the odds are in your favor. But, and this is extremely important, just like I explained earlier, this entire strategy is only valid if the bearish trend line is clearly visible. If you cannot draw that bearish trend line cleanly across the swing highs, then stop right there. Do not use this strategy. Without a well-defined trend line, this setup loses its edge and becomes unreliable. Why does this matter so much? Because a clear trend line is not just a visual aid for you, it's a key reference point for every professional trader, bank trader, and institutional investor analyzing the same chart. When the trend line is obvious and well-formed, it means all major market participants are likely interpreting the market the same way. That shared understanding is what gives this setup its power. So when you see a clean trend line, followed by a double rejection pattern, and then a breakout, that's your cue. That's when the market is telling you it's ready to shift direction. And when you act at the right time, this setup can deliver high probability entries with a solid potential for profit. Alright, so there you have it. I've just walked you through some incredibly powerful trendline trading strategies that you can start using right now. These techniques are designed to help you trade with precision by showing you exactly how to use trend lines the right way